So 10:30 oil numbers, folks. We like to go to the NADEX platform. Bottom line, take a look at these volatility trades. And if you haven't test-driven yet the NADEX platform, real easy to do. Just come over to our website at TFNN. You're going to see the banner on the top of the side. Hit it. Bring it up so you can get used to how these defined option contracts trade.
Perfect. So it's 10:22 right now. We got 8 minutes until we get those EIA numbers. We're looking at the September crude oil contract. Right now we're trading at 68.60. We've had some volatility, about 60 cents in almost both directions this morning. Crude been very volatile recently. So I pulled up the 11 a.m. expirations first, all right? And what we're going to look at is potentially setting up a trade where you're going to have a bullish spread where you'd be buying it. You're selling the bearish spread, so you have basically exposure upside and downside, and you're just looking for a pop one way or the other. Oil's trading at 68.60. We're going to have the choices of using 68.75, which is not that bad, kind of as our pivot point, where we'll have a $1.50 exposure upside from 68.75, and we'll have the same exact $1.50 downside from 68.75. And let's just see how this lines up. Let me pull these up a little bit.
42.
42, and keeping in mind here that you can see the bearish one being about $14 more expensive, and that represents the value you have because you're about 14 pennies below 68.75 of intrinsic value on the bearish one. So $42 for 11 a.m. Let's jump over to the 12 expirations. We're going to have the same exact price point, 68.75. Here's your bullish spread. Here is your bearish spread, 49.
Okay.
For noon, right? So 42, and again, same exact intrinsic value on the bearish side, right? So a little bit of a bearish trade because you have that head start to the downside. And then let's see where our 230s line up. So here's what's interesting is if you want to shift that around a little bit, and I'm just going to jump to the dailies as well. So 68.50, and instead of having 10 or 15 cents to the bearish side, this trade is now going to have 10 or 15 cents to the bullish side of intrinsic value. It's also going to have until 2:30, which you're going to pay some premium for. And it's also going to be $3 instead of $1.50. So you have 68.50 up to 71.50. You're buying the bullish one. That's where your intrinsic your intrinsic value is going to be. And then you're selling the bearish one, all premium. So that gets a little pricey, $64. Keeping in mind here, though, that you have $3 of profit potential.
Right.
Oil actually could move more than $1.50. So the 11 a.m.s and the noons, especially the noons, you're capped out at $1.50. There's a scenario, probably not likely, but oil could move more than $1.50. So you have $3 here. But keep it in mind, $64. So you would need 64 cents of movement away from 68.50. Becomes your break even. So give or take above, 69 or below 68 kind of becomes your break even. You have till 2:30. We've seen some big moves in oil throughout the day. So we had $42 for the 11 a.m., 49 for the noon. Both of those having a little bit of a bearish intrinsic value, or you could go for the 64 for 2:30 with a little bit of bullish. And it's 10:25. We get those numbers in 5 minutes, 10:30. We'll see what happens.
And let's bring this up right now. So right now this will be a delayed quote, folks. Right now we have 68.65.
Yep.
And if I look at this, look at that. Okay, so
we're going back to 74. We're going to 64. Where
you got up to 68.79. Okay, so we'll see where this shakes out. But the way that this is playing out, yesterday you couldn't handle higher price. Yeah, I would say 68.01. Okay, I think we're going to get some volatility out of this. Intraday, let's see what we have.
And that's
all we're looking for.
That's what you'd be, basically that'd be your market bias, right? If you're making that trade, because the market's charging a premium to have those defined risk trades.
Right.
And you're basically saying I'm willing to pay that premium. With the expectation that there's going to be more volatility than you're pricing in.
Right.
And you can always close out one side of the trade, like we've seen.
Yes.
Keep one open, or you can always do, either side of the trade directionally in terms of, we like to do the volatility trades because it's so easy you don't need to decide up or down.
Right.
But let's just say that you're looking for a negative move. I mean, this is not a bad trade when you're looking at slightly out of the money, right? So you're 12 pennies out of the money in terms of getting any value.
Yes.
And it's costing you $26, which is basically 26 pennies, and your break-even's only 25, 35 cents below where we're trading at, right? And you'd have profit potential if oil really tanked down to 65.50.
Yeah.
Nice trades.
Totally.
Yeah.
Stay right there, folks. Tommy and I are coming right back. We got the Dow Industrials right now trading down 101. NASDAQ is up 1. S&Ps are off 1. Come right back. Welcome back, folks. Tom and Tommy O'Brien, we do appreciate you growling and prowling with us. Crude inventories fell 6.15 million barrels. Gasoline fell 2.33 million barrels.
And we got the market jumping around on that news. So we spiked up to a high of 68.93. Remember, we're trading about 68.65, give or take, on that news. And we're kind of right back down and off to the races to the downside, man. It does not take long. First spike initially higher. We'll jump back into the full expectation. So expectation was a decline of about 3 million barrels. They came in at a decline of 6.1.
Yep.
And I think we were playing with the Bloomberg Whisper numbers. It was a decline of less than 3 million, almost to 1 million, somewhere in there. So decline of 6 million. That's why you saw the price spiking initially, right?
Sure.
A lot less oil, higher prices maybe. But guess what? They're going to dig into those numbers and the market jumping around. So those price points we were looking at again, it was either going to be 68.75.
Yeah.
Would be our 11 a.m.s and our noons. You would want volatility away from that price point.
Right.
Or if you
about
went
42 cents, right?
Yes, 42 for the 11s, 49 for the noons. And then if you were going to go for the 230s, that's where you could have turned things around and had a little bit of a head start to the upside, where 68.50 would have been your price point, but that was costing you about 65 pennies from that level.
Right.
So a little bit of a reaction. I mean, if you trade in volatility, you definitely want to see a miss in those numbers. So there's something to like, you know, in terms of what you're seeing there. And here's the full breakdown. So decline of 6.1 million barrels for crude. That's the headline. Estimate was a decline of 3 million. Cushing contributed 1.1 decline. PAV 3 almost flat. Gas below as well.
We're using gasoline.
Yeah. Decline of 2.3. Estimate was only about a decline of about 1 million. Distillates slightly off, and I mean, you know, and they break down a lot in here in terms of demand and so forth, but gasoline draw exceeding expectations as well, but gas not jumping around too much. And we'll check back on that chart one more time. Near the highs is where we are.
It almost looks like it's going to take off, man.
Well, you know, up, what, 30 cents in the last 12 seconds almost?
Yeah, right.
Making highs as we speak, 68.91. So we'll check back in, 10:32 right now. We'll see how this plays out for the hour. I'm just going to check back in on oil real quick. Oh,
look
man,
at that spike.
That's why I love to check back in real quick. You don't know. I mean, we just jumped away from it 2 minutes ago, a minute ago, right? And I was like, we'll check back in one more time. Quite a run. We had oil 69.25 now.
Yeah.
Off to the races, man. Oil, you cannot hold oil down. It is just running. We'll see if we hit 70 by the end of the day.
And that puts that volatility trade in a nice position.
It does. And I think it's basically no matter what trade you were making at this point, because if you had the 68.50, which was your 230, you're now a good 75 cents above that.
And we thought that was expensive.
And it was kind of expensive, but, you know, there's a reason why it's expensive, right? I mean, you got big news on the horizon, 5 minutes away. They're going to make you pay for that defined risk trade, and you're already above that level. And even on the 11 a.m.s and the noons, you were trading with a slight bearish, but it was only 10 or 15 cents, and with this type of a jump, you know, the 68.75, you only need 42 cents away from that point. So what is that, 68, 15, 20, you know, 20, 68.20 basically, and you can see we're above it. 69.20, excuse me, to the upside. Quite a run, 69.30. I mean, these are 5 minute bars we're looking at, and this bar, the low was 68.58, so, you know, talking about 70 cents of action.
Big numbers. Welcome back, folks. Well, Tommy and I do these volatility trades, and we get volatility in this oil market right now. Look at this thing.
What's going on, man? There was a 6 million barrel draw. Estimate was 3 million barrels. It would make sense oil would trade higher on that news. It did for a matter of about 5 or 10 minutes, and then quite an escalation to the downside. So these are 5 minute bars we're looking at. You have oil trading 68.43. That, you know, not super ideal if you were making that trade for volatility in terms of, well, just give it a few 5 minutes.
It wants to blow out this bottom.
Even the 11 a.m. has 5 more minutes, which you get one more 5 minute bar like this, you're going to be 50 cents below where we are right now. But either way, not the end of the world, as in even the 11 a.m.s, we had 68.75 being our price point, which we're now in a profitable position even for that. Keeping in mind that you can always exit that trade as it spikes higher, and then leave the other trade for value, as in this is one of those situations where you could have sold the bullish position,
It would have been pretty
retained value
wild.
to the upside, and then have the bearish position to be open to whether it's 11 a.m. noon or 2:30, whatever it is.
And this all happened in the course of 30 minutes, folks.
I mean, we were cracking up during the break, right? Saying, man, look at those bars, 5-minute bars. Talk about an acceleration. 68.23 as we speak, about to go off the air, 10.55.
So we just went down $1, I think, right?
Oh, more than $1. I mean, we spiked up to 69.36. We're now at 68.24. You're talking about $1.13. And like we said, it's not slowing down just yet.
Right. So. And this is where the time value, you know, when you take a look at the 11s and the 12s and the 230s, that's do the demo so you can see that correlation.
You get used to it, right? So we had a decision. You could pay $42 for the 11 a.m.s, or you could pay $49 for the same exact prices just for that extra hour. Was it worth it? Well, that's your choice, right?
Totally. Stay right there, folks. We get Fast Market coming up next, TD Ameritrade. Then, of course, we're going to our man, Mr. Basil Chapman.
Steve Rhodes?
Steve Rhodes, Dave White. I'll be back this afternoon. Have a great one. Have a safe one. Thanks, pal.
Thanks, man.
Wow! Go get 'em, folks.